it should send a shudder down everyone's spine to think that the government now wants to tax what they define as earnings in this way.
Good morning, everyone. Welcome to another episode of the Solve to Evolve podcast. We are doing this on a monthly basis now so that we can share our insights more regularly to the investors, the individual taxpayers, you, the business owners, about what's really going through or happening in the land of Australia. And so my name is Phil. I've got Bloxy and Jono. Gents, how are you this morning?
Good, thanks. Good.
Very well, never better.
Excellent. Love to hear it. So to start off, we just want to get into the 23-24 federal budget that was released by the Albanese government earlier this month, and some of the highlights I want to share with you guys. $14.6 billion cost of living relief package. That's massive. 1 million homes to be built over the next 5 years, starting from 2024. And this one's a big one. 3.25% predicted inflation rate, down from 7% this year. Can I get your quick takes on that?
Yeah. I mean, on the face of it, when you dig into it, like there's some big, high-level ideas there, but on the face of it, nothing overly exciting for business and taxpayers, but there are opportunities to be aware of coming up to year end and into the next financial year. What I was disappointed was there's very little in the way of encouraging innovation, and particular the R&D program, there's nothing about that. And also the export market development grant, looks like it's basically been defunded and axed. So I was, I've had clients who have benefited from that. So a bit disappointing on that front, but we'll get into some of the good news later on.
Good. What about you, Chris?
For me, Phil, I think the budget's interesting in that it appears to be targeting low-hanging fruit. So, for example, high-income earners and high-net-worth individuals who have high super balances. And it also appears to, as is trend for this government, to be kind of robbing Peter to pay Paul through taking large amounts of revenue in from fossil fuels and resources and using that to pay for extensive amounts of renewables investment.
Yeah, double-edged sword, right? Well, look, my key takeaway from the budget really is the 3.25% predicted inflation rate. I just don't see that happening. It's a big promise. We are still seeing a lot of rate rises, or we have seen a lot of rate rises over the last 12 months. I think there might be another one, but you can see that the government is trying hard to bring that down. Will the inflation rate come down? I don't think so, to 3.25%. I do believe that there's a bit of pain to come because the interest rates haven't settled. And I think once it settles, there will be a lagging effect on the economy and ultimately families.
Yeah. Yeah, wait and see on that one.
Yeah, we'll just have to see. Okay, so I guess let's get into more details as to what we took away from the budget and specifically for our client groups. Chris, can you start off? So what were one or two key takeaways for you?
Thanks, Phil. I think there's a couple of things in relation to superannuation, which is a big area of interest for my client base. And one measure that I wanted to hone in on a little bit was the taxation of super balances that are high. So over $3 million, the government has said that they are wanting to tax earnings over that amount. Now, this measure isn't slated to apply until the 1st of July 2025, so there's still some time before it's implemented. And the very important point, which comes from the papers, is how earnings above $3 million, the $3 million balance number is defined. So, big picture, what the proposed measure is going to do is it's going to tax earnings which have been defined and are calculated in reference to an increment in the balance. So that increment can occur for example, from unrealized market value movements. Now, that's a massive change to the concept of income for Australian tax law.
Yep. So taxing unrealized gains, paper gains, essentially.
That's
in
right.
super.
That's right. So it feels like what the government is trying to do is to introduce the concept of taxing market value increments in a very low impact way, low political impact way, because at the moment this measure is restricted to people who have a super balance of over $3 million.
Yes,
Yeah,
the rich.
Yeah.
The rich. And what it appears to me as what is happening is it's almost like sticking a wedge in the door so that it enters into the public psyche that unrealized capital gains can be subject to tax. And this is causing a big uproar in the agricultural sector in particular, where a lot of farming families have farms, agricultural properties in their self-managed super funds. So there will be pushback from that group in particular. But I think it's fair to say that there will be a ton of submissions on this one before the slated implementation date. So we should watch this space.
Yeah, that's a massive one there, Bloxy. I guess what you're trying to say is that this government is trying to introduce a new form of tax. It's no longer income tax. It's actually taxing unrealized gains or profits in a super balance or super account that has a balance of over 3 million. I guess that could lead and open a door to taxing other things.
Yeah, absolutely, Phil. And it should send a shudder down everyone's spine to think that the government now wants to tax what they define as earnings in this way. Another concerning element of what's been proposed is that while increments will be taxed, decrements will not lead to a tax refund. Decrements will be carried forward and offset against future increments. But once the market value has moved up, you will prima facie be subject to tax. The opposite is not true. So there's a couple of elements of this proposal that I think will receive significant amounts of feedback and pushback from various lobby groups in the economy.
Yep. So you're saying paper gains in super over 3 million, potentially subject to tax. Paper losses don't result in a refund.
Correct.
Yeah, interesting. So this could really start maybe a bad precedent, but if this was to happen, I guess families down the line, if they own property, if it ever comes down to goes down and applies to your main residence, well, families could be up for unrealized gain on their property. And I guess the issue I think they would face is where would they come up with the cash to pay that year on year? Because if you live in the Sydney market, or your house or your land is going up every year.
Absolutely. It's non-cash income, effectively. And that leads to problems. So another area of the tax law where problems are encountered with non-cash income is 83A, which is the taxation of discounts on the vesting of shares or options in employer companies. Employee share schemes. So I'm probably not as concerned about taxing unrealized gains on a main residence as I would be about investment properties or share portfolios, because 118B is very hard to change. But
the main residence exemption.
Correct. So what this is, though, is it's a further erosion of the idea that people can hold assets and not get taxed in Australia on unrealized market value increments, whatever those assets are. Another change that has recently occurred in New South Wales is in relation to the choice between paying stamp duty up front or land tax on your main residence ongoing.
Yep.
So I see this as an unintended but concerted effort from state and federal governments to get their hands on pools of assets or gains that have not previously been subject to any form of taxation or have been taxed at concessional rates, as is the case with large superannuation balances.
Yeah. So the concern is really, everyone looks at the 3 million balance and says, well, that's for high net wealth people only, the quote unquote rich. However, in 10 years' time, what's the median house price in Sydney going to be? It could be $2 million plus. So anyone who now is starting out and starting to earn more money into their super fund, you could eventually have a balance of $3 million. So that population will eventually grow. There's no mention of increasing that balance.
No indexing.
Or indexing, based on inflation. And as we all know, with inflation, asset prices are included in that as well. So that's something to think about with this.
Yeah, absolutely. And I should say, Jono, that it's not a concern that people who have more money are being taxed more. That's not the point. It may be, but it's actually the way that this law is designed to tax that gain.
Yep.
It's not an income tax. This is taxation of a gain that has previously never been defined as income in Australia.
Yep.
With a very limited exception of the TOFA rules, which apply to banks and big financial institutions where they can get taxed on unrealised gains if they make certain elections.
Yep.
But in the vast majority of cases, this has never been done before. So, like I said, I predict that there'll be some pretty interesting times ahead.
All I can say, I think the government's coming after us all and taxing everything.
Yeah. Well, they've got to pay for it somehow.
Yeah, I guess we'll get into that another day. Well, it'll be interesting to see what happens over the next couple of years in relation to that. But let's move on to the next point. Do you have anything else that you took away from the budget, Bloxy?
Sure, I do, Phil. On the less controversial end of the spectrum is the Payday super rules. Now, these ones are relatively benign and they're designed to start from the 1st of July 26. So we've got a little bit of time before they are implemented. Employers will have to pay super on the same day as salary or wages. Now, for the majority of employers who are currently compliant with single touch payroll, it should be relatively straightforward. There will be some stragglers. But again, what this measure is designed to do, and what we probably all agree with, is that workers should get paid what they're entitled to, and they should get paid it on time. And on that basis, this is probably a reform that is overdue. At the moment, employers pay super quarterly, even though they may pay wages weekly or monthly. This measure, again, it will also support the payment of super to the lowest income kind of cohort of workers who are casual or maybe even transient farm workers, construction labourers, and that's a good thing. I mean, it's scarcely a week goes past, definitely a month doesn't go past where there's not another wage underpayment scandal.
Yeah, you see it in the news all the time, don't you?
They're very frequent, and that's not only because people try to skirt the law. Some of that does occur, but it's because of the incredible complexity of the award system. And
mistakes.
Mistakes are bound to happen when you've got a plethora of rules for hundreds of different employee types. And so I think enforcing a faster payment of superannuation for the workers that you have is probably a welcome reform.
Yeah, I agree. I think it's going to benefit both parties here, being the employer and the employee. You will help manage the cash flow for the employer so that they know what's being paid and going out every month versus every quarter. The employees will get their super funds in their super balances on time or regularly, and that's just going to help compound and grow their investments. So,
Yep.
it's welcome change. I do support that one. What about yourself, Jono? What have you taken away from the budget after reading it?
I focus mainly on the measures for business. So it was good to see that the budget has reintroduced the instant asset write-off. So for next financial year, FY24, you can write off up to $20,000 per asset, and that's targeted to small businesses with less than $10 million turnover. And just as a reminder, so up until the end of this year, so we're in late May, businesses with less than $50 million turnover are able to expense any capital expenses.
Mm-hmm.
So there's no limit up until 30 June this year, but from next year it'll be 20,000. So I thought that was a good one, and we've seen instant asset write-offs in the past. It encourages small business to invest and makes it a lot simpler. They don't have to, makes it simpler for them and for us. We don't have to go into complex depreciation rules and which one do we apply and all that. We just claim the deduction. So I thought that was a welcome one. Next, I'd like to mention another measure that wasn't in this most recent budget, but last budget, which was the technology investment boost. So this was an additional 20% deduction up to expenses of $100,000 for technology expenses. So it's pretty broad what that referred to. So we've got draft law on that. It hasn't been formally signed off, but the draft law is pretty broad. It talks about hardware costs, equipment, software, systems and services, digital marketing. So for example, this podcast potentially, and e-commerce platforms, things like that. So spending on that up to $100,000, you can get maximum $20,000 additional deduction.
Yeah, I think that's a good one. Obviously there's a lot of businesses out there spending in that technology area, trying to digitize their business. So very keen to see how that plays out and if it becomes laws, which I think it will.
Yeah, there was nothing that I saw that, ended that one.
Yeah.
So that's a good one. And finally, a new measure for next financial year, which was announced in this budget, the energy incentive. So this works in a very similar way to the technology boost. So it's an additional 20% deduction up to $100,000. And this is to support businesses trying to save on energy bills and improving the energy efficiency of their assets. So I think that's great. And potential expenses include energy efficient fridges, heat pumps and cooling systems, batteries and energy storage was the examples that were mentioned. Main thing to note is we don't have any draft law on this yet, so there might be more details to come, and that's for next financial year. So something to keep in mind. But to sum up, there's some concessions there that business should at least consider. You could get up to $40,000 additional deduction by spending on those measures and fitting within that. So I think that's pretty valuable.
Yeah, it would be very, very beneficial for business owners to invest in that particular category. And I think the other one to mention is the skills boost, I believe. So the training. So if you do invest whatever amount it is into training of staff members and that's going to give you an additional 20% tax deduction as well. Is that correct?
Yeah, that's similar to the investment boost, but I didn't mention that one because there's a lot more red tape on that. So a lot more hoops to jump through.
Right.
For the businesses, it has to be, with a registered training operator, and I won't go into detail, but that one's a bit more prescriptive, whereas the other two I see as being more broad, and you could definitely fit into that if you spend in that area, technology and energy efficiency.
Yeah, good. Well, look, my key takeaway from the budget really is the government's plan to boost the cash flow for small business. So they're looking to decrease the GDP adjustment factor on PYG instalments and GST instalments from 12% to 6%. So a lot of business owners out there and individuals as well, they're pretty familiar with the quarterly PAYG installments. They'll pay that every quarter. And the way the government or the ATO calculates the size of the installment is based on the recently lodged tax return. So moving forward, for the 24 financial year, they're looking to reduce the increase or the increment of the installment. But ultimately, what business owners should be thinking about if they are underperforming or performing a lot better than they were in the previous year is to speak with a savvy accountant, or they might have one already, and that's to work with them closely to vary their installments up or down so that it truly reflects the performance of their business.
Yep. Help with their cash flow and
yeah, that's the
staying
biggest
on
thing.
top of
So look, a good example is, during COVID, prior to COVID, a business may be doing very well, very profitable, especially those in the hospitality, retail industry. COVID's come, bang, they have to shut down. There's no work available, no revenue coming in, but their BAS will be issued and an installment will be there as well, which reflects the previous year where there was no COVID. And so at that point in time, those business owners that don't have an accountant or an advisor that can help them with their installments, they would be up for that. And that could cause a lot of stress on their cash flow and on themselves personally. So it's always good to speak to your accountant, at least on a quarterly basis, just to make sure that that BAS that you're lodging and paying is a true reflection of what's happening in the business at that point in time. That's all we have time for today's episode. If you liked what you heard, please share this to your network. Otherwise, if you do have any questions about anything that we did discuss, please email us at podcast@solveaccounting.com.au. Until next time.
Thanks, Phil.
Thanks, Phil. Thanks, Jono.
Bloxy.
Thank you, fellas. Have a good day.
Well done. Let's have lunch.